Equity Mates.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to another episode of Equity Mates. Our aim is to help you on your investing journey, breaking down the barriers from beginning to dividend. Whether you're an absolute beginner or Warren Buffett, we guarantee Equity Mates will have something for you. My name is Bryce, and as always, I'm joined by my equity mate, Ren. How's it going?
I'm very good, Bryce. I would love to ask Warren Buffett to listen to an episode and for him to confirm that it has something for him.
Yes, but we have the next best person if it's not Warren Buffett.
Australia's Warren Buffett, you could say.
No, thank you.
Self-described?
No, as is now tradition for our show, at the beginning of each year, we do our bold predictions for the year, and we get Andrew Brown on from E72 Holdings. Andrew, welcome to the show.
Thanks very much, guys. Glad to be here.
So, as I said, new year, we've kicked off the Equity Mates season, and there's a lot going on, a lot of ground to cover.
There is.
So,
Let's just have a look at what we did last year, just briefly.
sure.
I came on 3 times last year, 30th of Jan, 7th of May and 8th of October, but who's counting? 30th of Jan was this episode last year, so bold predictions. I said the market would go down, and it certainly did. It peaked on the 19th of February.
Yep.
And certainly for Australia, that was the peak. We haven't reclaimed that. In the US, of course, we went down 38% and then have obviously bounced from the lows of the 23rd of March. So I said there'd be a correction. I said buy gold. That's worked out reasonably well through obviously a period that we didn't really foresee. I said there'd be lots and lots of volatility. Well, it's been above 20% on the VIX pretty much the whole way through with the odd spike. And I said the Roosters would win the NRL comp, and they didn't. On the 7th of May, we talked a lot about election risk, and I gave some stock ideas there. A couple are still gestating. They're called Sydney Airport and Treasury Wine Estates. I'm going to return to one of those. I gave you a lick which has nearly doubled, which was L1 Long Short Fund, LSF, which is on the basis the NTA would grow because of the portfolio and the discount would close, and that's happened. We continue to reiterate baby bunting for all you millennials with kids, so that's 280 to 530. And also at the other end of the scale, we gave you that perennial dog Boral and said things are changing. Well, they have. The stock's gone from $2.78 to $5.
Wow.
So that was good. The 8th of October was, I think, from a stock point of view, was the most fortunate one of all. If you were listening, if you missed that, tough. We said that Biden would be good for the stock market, much better than Trump, when that was a very non-consensus view. I think that's now right. SoftBank at 7,000 yen, they're 8,600. Exxon at 34.50, they're 47.
Nice.
So that's a big move. Vicinity Centres, 143 to 154 and a dividend. And the best one of the lot, of course, was Unibail Rodamco Westfield, which gave you a short squeeze par excellence, which, of course, is the topic du jour. 271 to well over $5. They're about 460 at the moment, so it's 66%. The market's up 10 since then, to give you an idea.
I remember listening to that episode and then just watching
Westfield.
Just
That was my
go for it, and Andrew would just be sitting there.
my favourite moment of the year, I think, was the 9th of November, a day not to be forgotten. So there you go.
There you go. So
on to this year.
We introduced it with Australia's Warren Buffett, and Andrew's just
delivered.
Put the case down on the table.
Looking forward to
maybe
this
a little
year.
bit more short term than Buffett. But.
Now, I have been negative on BNPL, so of course that's obliterated all of the profits you've made.
And historically, you've been negative on Tesla as well. I don't know where you sit on that now.
Oh, it's one of the great bubbles of all time still. I did a presentation at E72's AGM. There's 2 slides on our presentation there about Tesla. People forget there's 256 million shares which are not counted in the share count, which are restricted stock units, options, Musk's package that'll get exercised and everything else. So there's actually $1 trillion valuation on Tesla. Okay, you don't have
Wow.
to wait for the stock to get to, I think it's 1,064 is where it would theoretically trigger on the undiluted. So it's $1 trillion valuation already. The enterprise value is over $1 trillion. As has been proven out again in the fourth quarter result, they basically make money from selling green credits to other people. And one of their main buyers is now called Stellantis. It's Fiat and Peugeot merged. The growth in deliveries has got to be huge this year, and yet it's very clear in some key markets the competition is doing pretty damn well, especially in Europe. So, and how many EV manufacturers are there in China? Nearly as many as people. So I think, I mean, it is one of the great bubbles of all time. Does it have a role? Yes. Is the valuation sensible? Not in your life. Crazy.
Wow. Watch this space.
I know.
If you haven't caught the bull versus bear case on the Equity Mates TV show on ausbiz.com.au with Andrew and Anirban Mahati, go and check it out. It'll be on our YouTube channel or on their or on the ausbiz.com.au website. So, 2021.
Yeah.
Crazy things going on.
Already.
Yes.
January's the last 4 years of January have been nuts, by the way. 2018 in January, the S&P 500 was up 6%. In 2019, it went up 8% at one stage before it fell apart. 2020 last year, you might remember, it went it went mad, then flattened, and then of course we fell to bits in starting from the mid-February. And 2021, we've had just volatility plus. Not so much in the overall market. If you look at S&P, it's about flat on the year now. But what you've seen all these crazy surges in lunatic things, whether it's Bitcoin, GameStop, and obviously some of these short things. And that's creating all kinds of things. It looks like people go away, come back after Christmas and sort of injected themselves with something, some of these silly things.
Now, there's a few things there we're going to want to talk about, but I think before we get your first bold prediction, we should just ground when we're recording this episode, because things like GameStop probably will change so much between when we record and when we release. So Thursday the 28th of January is when Andrew's making these predictions. So who knows? If he predicts GameStop will half in value, that might have already happened by the time we release this episode.
Yes.
All right. So should we get stuck into it?
Yeah.
What's your first bold prediction for 2021?
My real bold prediction is that usually politics don't have a role to play in long-term equity returns, okay? Unless the politicians change the way that equities are taxed, or they change something like Peter Costello did in 2007, which enables you to put a lot more money into equities in an effective way. But I'm sorry to say, I think politics, believe it or not, despite the demise of Trump, politics will play more of a role in 2021 across the board in investing than they did in 2020. Okay, which sounds absurd. But let me explain why. I think there are three key reasons why that's going to be the case. The first I am going to flesh out, but not straight away, is economic interference. Okay. The second is China. Okay, and the third is COVID incompetence. Let's deal with the third first, because it does flow into other things. It's abundantly clear that politicians outside of Australasia and Vietnam have been largely incompetent at dealing with COVID, both at recognising it, both at taking measures to lock down and stop the damn stuff spreading in a big way and killing people. And now, thirdly, of course, their incompetence is showing in terms of actually vaccinating the population at a rate that they thought they could, and at a rate that the stock market thought they could. Okay? This ain't happening unless you're in Israel, in which case it's happening in droves. But the vaccination rate is just way below what people were imagining. It's going to take time for that to actually happen. And so all those people who've rushed into things that are going to benefit from a reopening of the economy are going to find that they might be 6 months too early. Okay? That's going to be an issue. The psychological damage of COVID, I think, is yet to be seen. The obvious way is we're all talking about how we go to work, 2 days a week and work at home 3 and all that sort of stuff. What's the psychological damage in terms of travel? Okay, if I free up travel and I say, yes, you can leave Australia, do you want to go to Britain? Do you want to go to the US?
Nope.
Nope. Okay. Do you
Well,
want
maybe.
to go to Vietnam? Yeah, please, I do. Yeah, because it's largely free of this stuff. It'll cost $20,000 to fly to Auckland. Because everybody want to go there. So the psychological thing of that's going to be really big. Let's dig in a bit, guys, into what I call economic interference, and this really comes in two places. The first is that we have enormous amounts of fiscal stimulus right across the world, and Australia's not immune from that. Okay, and so what that's done is it's put money in people's pockets that they don't have to pay back, but they haven't really earned. And they've gone out and, by and large, they've spent it.
Spent it on retail, given some of the recent results.
In Australia, there's no question it's been spent on retail. Okay, I have some cautionary notes there, which we'll deal with when we get to Australia in a few minutes. Okay, but the economic interference in the US is such that basically US GDP, US debt is now 128% of GDP. That's wild. Now you can debase that by printing money. Okay, let's make that clear. That's the new monetary theory, if you will, MMT. Okay, so you can debase it, but if you do that, you're going to get inflation. Okay. So the way that government extracts themselves from you and the economy is going to be really difficult. And of course, it's coming at a time when Joe Biden's saying, well, I don't want to. I want to put more money in your pocket. And I want, a bit more equality in the economy. And the government's going to play a role. Ugh. Now, what's intriguing is everybody says, well, that's going to mean the economy in the US is going to boom. That's not happening right now. I keep seeing all these universally bullish forecasts about the US economy, and I can only say I think they're going to be disappointed because COVID's lingering longer. There's more lockdowns lingering longer. Don't forget there weren't many lockdowns in the US, but there are now.
Let me just interrupt there and give the counter argument. If we don't see inflation, which we haven't really, there's some whispers of it coming through, but let's say let's hold inflation constant. The US putting more money in consumers' pockets rather than just buying bonds will stimulate consumer demand.
Correct.
And it will that will have a stimulatory effect.
That will have a stimulatory effect. The biggest conundrum I have, and the biggest conundrum every person looking at the stock market from a macro point of view, okay, rather than just bottom-up stocks, has at the moment is inflation. If you look at the US bond market, okay, the yield on a 10-year bond roughly is 1%. In the US, they have something called TIPS, which are Treasury inflation protected securities. They provide you a coupon plus the inflation rate. Okay, so your coupon is protected against inflation. If you take the yield on a nominal long bond, which is 1, and you deduct from that the yield on a TIPS security, which at the moment is -1. So 1 minus 1 is 2. That gives you the implied inflation rate over the next 10 years per annum. Okay, you can find all this stuff on the best economic website in the world, which is the Federal Reserve Board of St. Louis Fred Economic Stats. Okay, go to that, anything you want. The 5-year, by the way, is about 2.15% per annum. So the bond market is telling you we're going to have 2% inflation. To give you an idea, in March, that same indicator was at 0.5. Okay, so there's been a massive shift in 9 months. Now, every time those tips indicate, or nominal minus tips indicate 2% inflation, that's where it ends. Okay, every time in the last few years, that's been about the top of it, and everybody stops panicking and they go back and it sort of slips away again to indicating 1 and a bit. So at the moment, we're sort of at the ceiling, if you will, of where people's expectations on inflation are. If we break through that ceiling and in reality we get real consumer price inflation, and don't forget the Fed are talking about inflation, they want inflation to average 2%.
Yeah.
So that means it can be above 2. What if it gets to 3? What if the bond market really panics? okay, and yields really jump, like from 1 to 4, what do you think's going to happen to the stock market? Just remember, in December 2018, in the last quarter of that year, the stock market fell 20% because the bond rate got to 2.5. Okay? The market is so primed with low interest rates, and it can't really cope with even some modest rises in bond rates. So that's why people keep talking about something called yield curve control, which means basically using the Fed to keep the yield on 10-year bonds down. Okay? So we're going to have more and more of this interference. Now, if I'm telling you at the moment, it's really balanced. It's a seesaw between does inflation really start to break out or does it subside again? And we can spend all day talking about the pros and cons of that. Keep your eye on that. Because that is what's going to determine whether there's a bit of a shakeout in the stock market and then it turns from a shakeout into something really nasty, or things just settle down again and you can, you can buy the dip. Okay, and that's what's going to determine it. There's a lot of very smart people think this time that's it. Okay, I will give you some thoughts in a minute on why I am far more cautious than I even was at this time last year, and I was pretty cautious last year. And to my Twitter follower who says to me, Andrew, are you ever optimistic? Yes, occasionally, but not in circumstances like this, which I'll explain. The second bit of politics is China. China must be kicking themselves, okay, because they had 4 years to work out that Trump was a moron, wouldn't do anything against them whatsoever, and they only used it to get Hong Kong back. And towards the end, use it to get one of China's largest corporations into their spider web, Alibaba. Okay. The next play is Taiwan. Are they bold enough to make some sort of play with Taiwan to try and get Taiwan back? Create an incident out of nothing.
I have strong feelings on this, but this isn't a political podcast, so I'm not going to devolve too far into it. I can just see Bryce's eyes boring into me.
No, it's not. This is not. It doesn't matter what I think about China and Taiwan. It is a question of what if China made a bit of a more aggressive move on Taiwan? Would that be good for equity markets around the world? Big call.
I just don't think. I think the US security guarantee over Taiwan will protect them, because if they don't guarantee Taiwan's security, that puts question in Japan's mind, in South Korea's mind, in Australia's mind.
Absolutely, it does. I don't disagree with your. We're not here to discuss Chinese Taiwanese politics, but it's pretty likely. I would have thought, given the way that China are being relatively belligerent and there's been very little opposition to them. They've just bowled over things. There's been nothing there, so they're going to test out Biden and his administration. Okay? Biden's quite hawkish about China, don't forget. So there will be tension with China again, but in a different way. It's not going to be in 280 characters. Okay? It's going to be in a very different way. But that's going to rankle markets from time to time as well. So there you go, 3 political things, which is economic interference, which has the capability of mistakes. Okay? Has real capability of mistakes. And if you think we're going to end up with 0 interest rates forever and a day, think again, we're not. Okay, that's got implications. China and COVID. So politics is going to play a role, and it's going to create volatility. I think the one common factor between 2020 and 2021 is going to be markets are going to stay volatile. Okay, whether it's up or down. And I think the chance of dislocations in markets are very real. So the chance of 15 to 20% downturn in the market, not necessarily in a few days like we had in March last year, but the chance of a real dislocation in the market is, I think, pretty real. Let me maybe just pad that out a little bit. Okay, why? Well, the simple fact is that we've got groupthink. Everybody's on one side of the seesaw. Okay, so everybody's all in already. Okay, why? How do we know that everybody's all in? What do you think the short position in Apple is?
Not a lot.
Yeah.
Not a lot. 0.5.
2%.
No, it's 0.5 of 1%.
Wow.
The short position in the SPY, which is the S&P 500 ETF, it's the lowest it's been in a decade.
Wow.
It's 2%, and the short position in the median stock in the US is 1.5%.
Wow.
Okay, so the shorts. This is. Don't forget, this is pre-GameStop. Okay, I'll explain what GameStop's done in a minute, because it has actually taken a lot of other short positions out of the market because people have run for protection. Yeah, I have one short position that is not particularly big, but I do have a short position, and it's one where about 17% of the stock is short, so that's quite high. I don't usually go into things where it's that proportion of the capital that are short, and yeah, that stock's, you don't put on sort of 30% in a week. Okay, even though, you know, it's a company that's got fraudulent disclosure and it's actually got a dodgy product and everything else, which means I can't tell you what it is because I've just defamed.
Let's keep on the broader picture, and then we'll go to shorts in a bit.
So no, the broader picture is basically that short positions are right down. Okay, so that tells you everybody's all in. How else do you know everybody's all in? I've got a bit of paper in front of me here, which is the predictions for the S&P 500 for the end of the year from 15 leading Wall Street strategists.
Nice. All up.
All up.
Yeah.
Okay, they've all got EPS growth. EPS for the S&P 500 for 2020, which is obviously COVID impacted, is about 138. They've all got EPS. The lowest EPS here is 165, and Binky Chadha from Deutsche Bank has 194. Binky, whatever you are smoking, I want some of it. You are kidding. All right.
I'm here for the Andrew Brown Binky beef.
Absolutely. So, and it means that you have a PE basically of about 23 for the end of 2021. So we've got massive earnings growth captured by everybody. Okay, the mean is about 169 for the S&P, and in calendar 22 we're up to 197. Okay, and when the economy was functioning really reasonably in calendar 19 with a 23% tax rate in the US, the EPS was 163. Does that make sense? No, it does not. Okay, it doesn't, even with an S&P that is 25% made up of the big six.
Yeah.
Okay.
Yeah.
Now, again, I don't want to just keep being the contrarian guy, but I'm going to be.
You should be.
Some of the earnings that we've seen out of the US so far have been pleasing.
Yes.
They're beating expectations.
Yes.
Does that not fly in the face of your criticism of the Wall Street expectations?
No, because they're expectations that were dragged down and down and down and then have been refined up slightly because of COVID. Okay. These guys are looking at and girls are looking at a much more normal, or they think a much more normal economy in calendar 21. I'm not sure it is going to be quite as normal as they think. And we know, over the years, on average, Wall Street strategists are about 10% too optimistic in their earnings. Okay? Fact. Go back, look at it. Look at FactSet, for example. Okay? This time, they're way too optimistic, in my opinion, at 23 times earnings, in my opinion. And we've got interest rates that are extraordinarily low, which it would be difficult to get any lower to make equities, more attractive. So it says to me, everybody's all in. There's not a lot of short positions. Forget GameStop stuff. There's not a lot of short positions in the general market, and there's even less actually after GameStop. Strategists are universally bullish. Okay. You've seen the turn in the stocks that are basically economically sensitive. They've rebounded quite nicely. And everybody says, well, this is great. We're all going to be traveling. And then over the last little while, all of a sudden, the vaccine's not distributed properly. There's not as many doses as people thought. We're going to need to do more things. And so I think the groupthink that we now have is actually going to get placed under much greater pressure. But then if that's the case, and if the economy is not as strong as I think, then is inflation going to really be 2%? This is the real conundrum. So you must keep an eye on bond rates. and in the US, and you must keep an eye on US inflation indicators.
Yeah.
Okay.
I mean, the way you could see it playing out is if the market is weak and the economy is weak, as you were saying, and then where does inflation come from? Well, potentially it goes back to your second point around economic interference. Like,
Yeah, absolutely.
direct stimulus checks combined with a $15 minimum wage,
Yeah,
could be inflationary enough.
absolutely.
Yeah.
What you don't want to see is the economy not being very strong and inflation. That's called stagflation. You saw that in the 1970s. It's, that's not horrible for stock markets. It's death.
Yeah. Well, and then what?
Okay.
Interest rates have to.
Yeah,
go up to
interest
control it.
rates go up,
And
and,
then
you've
the
got a weak
market-
economy. Don't forget, if interest rates start moving up in bond markets, you're talking about interest rates moving up in markets with all economies saddled with certainly government debt, which I accept you can melt away, and in certain economies with consumer debt, which you can't. So what I'm telling you is the bold prediction is that politics will play a big role, number one. Number two, that will continue to result in quite high volatility in equity markets. That's not going away.
So
Thirdly, we'll have a dislocation
yeah.
at some stage during the year.
So that was a big discussion about the US, and there's an obvious reason why we talk about the US, biggest market. It sort of leads the world. In Australia, do you think a lot of these predictions will hold true?
Funnily enough, no.
Okay.
We are. I mean, the
Nice.
simple fact of life is, I mean, we are seriously in a bubble. You know, I mean, some of the things I've said about COVID incompetence clearly don't reside here.
In this case, when you say we're in a bubble, you mean like a geographic bubble, like a good
Yeah,
bubble.
absolutely, a good bubble. We do have some of the same issues. Okay. So, but my next bold prediction is, and I think this is, I think you can virtually back this with 100% certainty, is there will be a federal election this year.
I've been thinking, the same thing.
There will be a federal election this year simply because the longer this government goes towards the May 22 deadline, okay, which is when they have to go, the longer they go, the probability of them winning and winning well reduces. Okay.
Well, the probability of Albo actually getting in front of a camera and saying something increases.
I'm sure the Wiggles are working on a new song. Is it "Wake Up Albo"? Because look, it's difficult. I mean, being serious, it's very hard as an opposition leader to land blows when you're looking at, let's call it a wartime environment, because ostensibly that's what it is. Okay, so it's very hard. So incumbency is huge at the moment, which is why, if the Liberal Party are sensible, they'll go fairly early. Okay, so you might be looking at a mid-year election. So that's the bold prediction. Now, the obvious bold prediction from that is that the Liberals will win hands down.
Yeah.
Okay. What if they didn't? Don't forget, the Labor will win Western Australia when that election is. They won Victoria. They won Queensland in a landslide. They won my favourite place in Australia, the ACT, with an increased majority.
I feel like the ACT isn't really a battleground territory, though.
It's a battle if you're a Liberal in the ACT, that's for sure. It's a bit like being Trump in DC, isn't it? So, I mean, the interesting thing will be, will that cause any ructions here? Markets don't like elections because they're uncertain. People get uncertain. I think the consensus of Morrison winning with an increased majority is pretty reasonable, to be frank. Simply, and that's not a political statement by me, it's a simple fact of political analysis that incumbency in a situation like we've had works really well. But it will maybe shake markets around a little bit, so we'll have a little bit of an issue there. The other issue is economic interference in Australia means JobKeeper. Mm-hmm. It's been monstrously successful. I would argue it's been perhaps too successful. I don't oppose it. I think it's brilliant. I think it's been a bit too successful. And as you start to pull it away, you must be so careful at analysing earnings looking backwards. So we're having some super retail earnings at the moment, even from companies you thought were dead. All of a sudden... and don't forget, they come in 2 or 3 bits, okay? JobKeeper works on their revenue line because people are spending the money, but JobKeeper comes in on their cost line as well. It's taking costs out of their business. And also, obviously, the landlords are taking a hit, which is damn right too. It's about time they did. So that's really helping. So be careful. Don't put too big a multiple on those kind of things. The impacts have been spectacular. Yeah, even to really well-managed retail companies. I mean, just have a look at the results JB Hi-Fi are posting for the first 6 months. And I mean, they're a spectacularly well-run company, let alone the guys who've scrambled a bit beforehand. So I'd be really careful about retail stocks in Australia. Okay, don't look at the numbers now. Don't capitalise the numbers now going forward too far, because you'll end up making some mistakes and they'll fall in a hole at some stage. I think our economy is going to go through a tougher period of time, quite frankly.
But if you're calling an early election, will that not be a reason for the government to slow down the wind back?
I don't think it'll slow it down that much, because I think they'll be able to rest on their record, if you will. And they need to catch Labor while Labor are having a debate about how should Labor look going forward. Go now. I mean, if I was Morrison, I'd interrupt this podcast and call it.
Well, if he wants to call the election on this podcast, he's more than welcome.
That's right. So I think that will create some issues. And again, I tend to think what we'll see is, I think, our market may struggle a little bit. It's expensive. The industrial side of the market's at 30 times earnings. You look at, companies like, when Wesfarmers spat out Coles, to envisage that Wesfarmers stock would be back in the mid-50s.
It's crazy.
It's crazy. I mean, sure, they've got a couple, they've got 2 or 3 businesses that are massive beneficiaries of what's gone on. But wow, the stock market's capitalising that well into the future. And that's sort of a bit, to me, that's doesn't make too much sense. So I think we're going to go through a bit of a rocky period here in the stock market, for the simple reason the US, I think, will have a dislocation at some stage. The US may well end up back where it is. It may just dislocate at some stage and then rebound, as some of the things I've spoken about maybe start to resolve themselves towards the second half of the year. We might see the same thing in Australia. I'm not that negative about the overall index in Australia, because you've got 4 banks that are not that expensive and have not been hit as hard as we might have thought. You've got 3 major mining companies that are dependent on the Chinese economy keeping firing, but the iron ore price is so far above any long-term norm that they're just making super profits right now. Then you've got Wesfarmers, your sort of Woolies, things like that. So it's hard to create a ridiculous bear scenario for a loss of the top 10 stocks in Australia. So I can see them coming down, 15% or so like that in line, but they're all kicking along reasonably well. And so it's hard to see a really nasty scenario for the Aussie market. I can see a worse one for the US market. But don't forget, we didn't go up as much, because you're talking about unwinding tech valuations that are a bit too high, to be blunt, notwithstanding the great companies. So I'm not as negative about the Australian market at an index level, but I'd be very wary about chasing retailers and things of that nature at this particular stage. The one thing, I think, the other bold prediction is, one of the aspects of 2020 was it was a stock picking market, quite clearly.
Yeah.
Okay. And I think 2021 is going to be exactly the same. Genuine positive bold prediction, I think we're going to have a lot of takeovers.
Yeah.
Why?
Yeah.
Why? Think about what we've just said. I've said we're on a knife edge between 2% inflation in the US. Does it really come through, or does it not come through? Okay. If you're going to do a takeover that's debt funded or partly debt funded, get on your bike, quick, move.
Isn't the other side, if you want going to do it, like if you're going to issue shares with these crazy valuations, it's the right time to do that
Absolutely
as well? So
right,
on either side of the ledger,
either side of the ledger, if you've got if you've got stock arbitrage, if I can put it, or stock valuation arbitrage in your favour, do it. I'll give you a great example that's happened, which I've been the beneficiary of, and I'm spewing about. I was a lucky shareholder in a company called Explore Wealth. The stock code's XPL. It received a takeover bid from Hub in November. Hub 24. So the takeover bid was a 202% premium to the prior close.
Wow.
Okay, the stock was 7.5 and the bid's at 20. Okay, but the bid is part cash, part scrip, or you can choose all scrip or all cash, but there's limits on that. Hub trades at 7.5% of its funds under administration on its platform. Okay, so it's sort of a $1.8 billion company. Explore Wealth, when the bid came, Explore Wealth was capitalised at $15 million and had $15 billion on its platform. And to save you the arithmetic and get the decimal point in the right place, that's 0.1% of funds under administration. So that's a 70 times valuation arbitrage on that metric. So if you're Hub, I mean, I'd issue more and more scrip. So you're seeing things like that. And in fact, what you've seen is a lot of takeover activity. There are virtually no listed financial platforms now. They've all been taken over in 6 months. PowerApp, OneView. Obviously, Explore Wealth is gone. There's a couple still around. Premium, Mainstream. So, which you won't find a small cap fund that doesn't own Mainstream. And they're just waiting.
So what is the theory that they'll just get taken over by
Absolutely.
a bigger player because then the market values that funds under management
That's
more?
Funds under administration.
Funds under
more.
administration.
Okay.
Yeah.
And don't forget, a lot of this, not specifically for Mainstream, but a lot of this has been caused by the demise of AMP. Okay. And the demise to a degree of IOOF. Okay. And so directly from the Hayne report. So the new players, the Hub 24s, the Net Wealths, and others are just gobbling up things. So if there's a lesson from that, which you guys of a slightly younger vintage than me know full well, when things move, they move real quick. Even in corporate land, they move really, really quick. And if you don't move, you just get left behind. So, yeah, that's not changing. Okay, and the reason that's not changing is because, you know, everything's migrating technologically up into the cloud and everything else. So tech really does work, and tech speeds things up into hyperspeed. So that is going to continue, I think, with takeovers. Alec has quite reasonably said if you've got cheap debt and for the company cheap equity, for the investor expensive equity, get out there and print it now while you can. Okay, and particularly if there's some companies that are struggling in the mud.
Yeah.
I will give you 3 companies that I think will be under threat of takeover in 2021.
I've got one.
Really?
Yes, it was in my bold prediction, right? Remember? I'll tell you.
Yeah. So
You can't remember. What are they?
what are they? Okay, let's get stock specific now and actually explain in that environment. Okay, so we've couched the environment. Okay, so in a sense, it's going to be a bit like 2020. A lot of political interference, some dislocations, a lot of volatility. Okay, so how do you play in that kind of environment? How am I playing in that kind of environment? Just to preface some of the stocks I'm going to talk about, the kind of portfolio I have at the moment, I have short positions in fad stocks. Okay, I have very small shorts in a large number of fad stocks. Okay, so some of them are going to get wrong. I won't get stopped out because the positions are too small. But
sorry, just when you're saying fad stocks, you're not. That's not an acronym. That's just like the fad of the day.
The fad.
The GameStop, the Tesla.
Yeah, no, not GameStop. No. I mean, the one thing I'm very careful about is what is the short interest as a percentage of the outstanding capital. Okay, so I at the moment it's come down a fair bit. The short interest is only about 7% of the capital, but I can't see Maya surviving seriously in the long term. But when there was 17% of the stock was sold short, I just wouldn't play, and that was absolutely the right thing because of course the stock bottomed at 12 and he's been to 50. So and that's got the guys are doing a better job, but it still doesn't. It's not going to diffuse the long term. So I've got a lot of SaaS stocks in the US, that are just priced at crazy numbers that assume perfection in execution of a business model at hyper growth rates. Okay, so it's all about saying, hey, what's the market assuming? And it's assuming 30 to 40% growth out till I've got great grandkids, and that's not reasonable. Okay, and so it's priced for that. So I've got a whole bunch of things that say some of these are going to fall over and not make it. Others I've got, fads. I mean, what one I'm happy to discuss. I have a short Entrepanian, which is a pet insurer in the US that trades at about 14 times book value. Every other insurer I look at trades at 1 and a bit.
Wow.
It's basically I outlined in our presentation, what the valuation lunacy around this thing really was. So we've just got to wait for results to prove up the case. So that's one side of my portfolio. On the other side of my portfolio, I have 5 stocks that are controlled by billionaires, which trade at about a 50% discount to NAV. Not 10 or 20, 50. Okay. Those stocks are Exor in Italy, EL Corporation based in Toronto in Canada, which is just basically a stock portfolio. Okay, with an insurer. Exor is the controller of Stellantis, Ferrari, C&H, and has a reinsurance business called Partner Re, which is very valuable in the current environment. The third one is a company in Norway called Treasury, which is controlled by the Wilhelmsen family. Bit of a problem with the Wilhelmsen family. They don't get on with each other at the moment.
Is that why it's at a discount?
Well, it's only got one asset. It owns 11% of Hyundai Glovis, which is the world's largest car carrying boat company. And when you take the Hyundai Glovis share price, actually the discount's more than 50%.
Wow.
I own a company in the US called Varley, which basically is a 4-companied interconnecting thing where there's a 6% free float. And the main asset is Cronus, which is the world's 3rd largest manufacturer of titanium dioxide. That's the white stuff that goes in your paint. Okay, and the final one is a company called Hal Trust, HAL Trust. Hal stands effectively for Holland America line. So it's the old cruise company that got sold to Carnival. It's the Van der Worms in Holland. They are extraordinarily secretive. They run a whole bunch of companies. They are the main shareholder in Grand Vision, which is an optical business which is being sold to Luxottica. And then they have a major dredging company as well. They're a fascinating but extremely secretive family, and you have to do a fair bit of homework to get to the numbers. But it's fascinating, and they're about to get a $5 billion injection of cash from the sale of their Grand Vision stake.
Wow.
So all these things are monstrously cheap. If you're a GameStop player, they're also monstrously boring.
So you've spent your summer studying reclusive European billionaires, I guess.
I've spent part of it studying reclusive European billionaires. Yeah, the others I knew about. So they're really cheap. So that's a barbell. I will give you some more conventional ones.
Before we move on, I think a lot of people would be interested. You spoke about a Dutch stock, an Italian stock, stocks from around the world, but not markets that we often speak about.
That's right.
What's your process for discovering those stocks? Because you obviously have a lot of detail and you understand what assets they hold, but at a high level, where do you start that process?
I start that process with a lot of reading. Okay. People say you've got to do company visits. Well, if I rang the Van der Worms up, they can send someone round to make sure I didn't. You've got to just read and read and read, and then something piques your interest because it's your kind of company, it's your kind of way of looking at things. Mine, obviously, I love deep discount plays. That's obvious, and I acknowledge not everybody does. And so I then have to do the really hard and analytical work. And in the case of Hal, that involves quite a bit of accounting work. It involves delving around. It involves getting some other filings. It involves going back in history to discover when they bought various of the private businesses, and just going back and then building out some models as to what these things are earning and what they might really be worth.
But if we stick at a high level, when you say reading, like where are you reading about these reclusive European billionaires?
Look, everywhere basically. Market releases, hedge fund letters, obviously. Bloomberg, business mags, everything. Just everywhere I can get information. And it's a matter, as you all know, and you're probably better at it than I am, it's a matter of how do you distill that down. So, I mean, one of the key things, one of the big advice I'd give any of your listeners is you will have an investment process of your own. Okay, it might be that you love hypergrowth companies and you're really good at analysing them. Okay, stick to that. Don't come and listen to me talking about 50% discounts to NTA because you'll go wrong. Okay, likewise, if I go into your hypergrowth area, I might go wrong.
I think you.
Although
would
when
go
I go
mad.
into it, when I do occasionally go into it on the long side, it usually works. But so it's stick to something that you know that's good. You've got a process for doing it, and if that works for you, stick with it. The key thing is stick with it. Have the discipline. Don't deviate. Okay, because there's lots and lots of different ways, particularly in markets like this, and with the market access you've got globally now through one platform or other to figure things out.
All right,
Let's go on to some Aussie stocks then, shall we?
let's do it.
Let's do it. Okay. I'm going to repeat two things that I repeated this time, that I said this time last year. One is, I think, bold prediction, we will have a bank merger.
I did remember that one from last
Do
year.
you remember that?
Yeah.
Okay. And it's not going to be in the big four. Okay. But the interesting thing that makes it more likely now is that ME Bank is up for sale from its not-for-profit fund shareholders. So that's going to interest somebody. And, of course, AMP is, it's had a non-binding, non-everything approach from Aries at 185. Is it a sum of the parts story? No, I suspect Aries will if it goes ahead, end up taking the whole, and the market says it's not going ahead, by the way, of course, where the AMP share price is, then at some stage AMP Bank will be sold. Unfortunately, they've missed the top of the market by a mile because bank price earnings ratios and price to books have been compressed. Okay, but that is potentially available. And then you've got the three publicly listed bigger small players, so Suncorp, which might spin the bank, Bank of Queensland and Bendigo, and then obviously you've got a couple of smaller players. So I'd be stunned if there's not a bank merger, because I think one of the bigger small players will want to take one of those two that are available. So bold prediction, domestic equities number one, bank merger. Nice. Okay, stocks. Two stocks which I think, well, three stocks I think in the domestic arena are obvious takeover targets. And I have a shareholding in all three of these to disclose. The first is Symage, which is the old Leighton. Symage is farcically cheap, and it is in a great area of the economy, which is basically slopping down concrete and building stuff, because it's government funded. Why? Because the government's going to keep spending on this stuff. Okay. It may hit a roadblock at some stage because our population, of course, is not growing at the rate it was. Okay. But government won't think like that. It will spend for the future, and I don't disagree with that. The attractions of Symage, it's on about 11 times calendar 2021 earnings. It is so badly analysed by the market, it's not funny. Okay, the analysis of Symage is really poor. I'm not critical because it's understandable why. Because 77% of Symage is owned by Hochtief, which is controlled by ACS, the Spanish company. Okay, so there's not much of a free float to write brokerage business with, and the chance of being involved in corporate stuff's fairly small. So the reason it's badly analysed is Symage now has two 50% owned businesses, which are massive. It now only owns 50% of Tees because it's sold half of it to Elliott Management. And it has 50% of a company called Ventia. Ventia is a $5 billion turnover company that warrants about 3 lines in the annual report because it's held off balance sheet. The value in that's huge. You can see in the financial review today, the short position in Symage is 18 days worth of trade. About 7 or 8% of the free float is short. Why you would short Symage, I have no idea, because the stock is backstopped by the fact that they keep buying back shares at a level when they can. The Spaniards don't necessarily want to spend that much of their own money on taking out the rest, so they'll do the Kerry Stokes way of gaining control, which is just to have buybacks and keep your own shareholding. Nothing wrong with that. It's legal. So I think you're underpinned by a buyback, 11 times next year's earnings in a good sector. There is a chance of a takeover if the stock were to fall sharply, and there's a short position there as well.
When you say there's a chance of a takeover, though, wouldn't the Spanish company want to get rid of it? Like, because if they own 77%...
They can't take all the cash flow. That's the issue. When you only own 77%, all they can do is get dividends, and they haven't had one in 2020.
Right.
The other thing about Simic is all the negatives about Simic, which were pointed out 18 months ago, have all been cleaned up. Okay, so the Gorgon contract has been properly accounted for, written off now. The issues with factoring and reverse factoring that are in the accounts are now basically out up front. There's no hiding them now, which they were doing a bit 2 years ago. They're not hiding them now. So basically everything's transparent now. So I think that's pretty good. I have an ownership. Number two, we discussed this time last year, and it was a woeful failure. It was Treasury Wine Estates.
Yeah.
I think it's pretty obvious now. We know the reality of China. Now we know that 30% of their earnings won't be there in for the foreseeable future. They've got to basically put that premium range and masstige range elsewhere. They're targeting America. Not easy. They can target various other places, but they're about at their weakest now. So there is a possibility if the shares were to come down materially that now's your chance to grab those great brand names. If you don't think brand names have value, have a look at Remy Cointreau, which is traded in France. It owns obviously Remy Martin, Brandy, Cointreau. It also, for you millennials, it owns Mount Gay Rum, which I know you all drink. And it owns Brunelli Whiskey and Gin. That trades at about 60 times earnings. Okay? That's ongoing earnings. So TWE, I think, is a real possibility, particularly if they get the transition wrong, and it's risky. And, they've got good management, but there you go. The third one is a new stock, is doTERRA Royalties. It's basically a 1.232% revenue royalty on BHP's, it's predominantly BHP plus two Japanese companies, Mining Area C. I wrote about that in the last quarterly by East 72. I went back and researched the history of all this going back. Australians don't know how to value royalties, bluntly. Canadians know how to value royalties.
Which seems strange, because if the royalty has an end date, isn't it just a discounted cash flow?
Absolutely.
Yeah.
Of course it is. But it depends what numbers you put in. Okay? At the moment, iron ore is very high, and that's keeping people saying, we think the iron ore price is going to come down. Well, when you look at doTERRA, it's not reflecting the kind of iron ore price we're getting, partly because the production does not get to peak level until 2023. So I think doTERRA royalty, to be frank, if a Franco-Nevada or a Wheaton Precious Metals don't gobble it up or somebody else, and if it got so low, what's to stop BHP gobbling it up and actually saying, good, we don't have to pay this anymore. Okay, so I think the risk on doTERRA is the management think they can buy other royalty streams and they waste the money. Okay, this is the best credit-rated, best quality royalty in the world, bar nothing. Okay, bar nothing. All right, ain't a better credit rating on a royalty than BHP. So I don't think Australians have grasped that. I don't think they've done their DCFs properly. So I think that if it may still be around at the end of 2021, but I'd sort of I won't bare my bum in Burke Street, but it won't be by the end of 2022. The fourth interesting thing is to return to an old favourite, which I first mentioned on the very first external podcast of anybody other than Bryce and Wren on Equity Mates, which I think was 2017, guys.
Yes.
Is that right?
Yes.
Okay, and one stock I mentioned then was PM Global Capital.
Oh,
PGF is the stock code. It's a lick. The stock's about $1.22 at the current time. The NTA is about $1.45. What I love is if you think about what I've said about the environment, it has a portfolio, I think, that really fits that. It's got really good resource exposures. It's got a lot of domestic banking exposure, not in Australia, but globally. So the sort of JP Morgans of the world, that sort of stuff. It's got a lot of alternative investment managers, which suits the takeover theme. So it's trading at a nice discount to NTA. It started to do a few things in terms of being a bit more sensible on capital management. It had a partial tender offer for its stock last year. You could tender back 10% of your stock. So that's a little bit better than they've been in the past. I do like the manager, PM, Paul Moore. He's real different, okay, which is a real benefit in this kind of environment. So I think at those kind of discounts, that's well worth returning to, and it fits the environment. And my final stock, I've been in this ever since I opened E72 and its predecessor company. And last year, it's made more money than it's ever made in its life, and the stock price doesn't reflect that and does not reflect the environment going forward. And it's an American company called Virtu Financial. VIRT is the stock code. It is a market maker. It's about the only listed market maker in the US. It went from making about $2 million a day market making in the first quarter last year, or prior to that, to making $12.75 million a day.
Wow.
In market making profits in Q1 last year with high volatility. It's on at 5 times 2020 earnings, but they're very high. So on an ongoing basis, I think it's on about 8.5 times sort of kind of maintainable earnings, which is really cheap. It has technology others don't have. So it's superbly run, and it pays a 96-cent dividend on a $27.40 stock price. Okay, there's a real barrier to entry to what these dudes do. Okay, it's just done the biggest automatically generated algorithmic trade that it's ever done in a single trade, and that was actually done in Australia.
Right.
By its thing Posit, which was an $87 million trade, single trade that was, algo matched. So it's a really smart company with great technology, and I think we'll continue to benefit from the sort of environment we have going forward. So there you go. I do think it's going to be an interesting year. I don't necessarily think we're going to end with markets up significantly. And I do think we'll have some dislocations, but I suspect we may end up coming in here and the indices are not too far from where they are now, but they may have been on a pretty big ride one way or the other. And I just advise everybody, just please be cognizant of the fact there's so much groupthink in markets. The consensus is all one way, okay? And on that basis, you have to be very cautionary because of where valuations are and the consensus being just too obvious. So, it might be time to just lay a few bets, or if you haven't done already against that, I quite clearly have.
Well, you have left us a lot to ponder over for 2021. We had you on, 3 times last year?
Yeah.
I'm sure we'll have you on
Absolutely.
3+ times this year.
Please note, all the stocks I've mentioned, certainly the last 5, I have positions in those. I have long positions in all 5 of those. So if they go up because of your buying, I will benefit.
We're going to be the Wall Street bets of Australia.
Hey, I was thinking we've done a whole bold predictions episode without talking about Afterpay,
Perfect.
Tesla, GameStop.
Perfect.
So I'm proud of us all.
Well, Andrew,
I still think Afterpay is ludicrous. The valuation.
no, let's leave it. Let's leave it.
Yeah.
We will leave it there. Just to kind of recap very quickly, though, you've had politics to play a big part in the equity market dislocation, potentially 15 to 20% after high volatility continues. Federal election in Australia, US economy the Australian economy to struggle more than we think. 2021 to be the year of takeovers.
Yes.
And then you've left us with a bunch of stocks that we will put on our socials for everyone to have a look at. But Andrew, a big thank you.
My pleasure.
Always
Enjoy and please everybody do the work. Okay, don't
Yes.
just look at a website or a subreddit or something
Or
like
listen
that,
to a
and,
podcast.
and spend your stimmy on trying to make tendies.
Yes.
Yeah.
Aren't I such a millennial? So,
I think you have a Wall Street
beware.
Bets. You have a Reddit account and you use Wall Street Bets, I think.
I certainly have a Reddit.
And I think if people want to take Andrew's advice and read widely, a good place to start your reading might be the E72 presentation that he referenced a few times.
Yes.
Yeah.
As always, we would love to hear your bold predictions for 2021, and a reminder that Equity Mates doesn't stop when you finish with this podcast. You can email us at contact@equitymates.com. Follow us on all the social channels or visit equitymates.com. If you're stuck for podcast recommendations, we do have the Get Started Investing series as well, which is for all you beginner Buffetts. And our latest podcast is Comedian v Economist, where we hear comedian Adam and his brother Thomas break down macroeconomics, which at a time like this is super important to understand. So head over there and have a listen, and you might be the next Andrew Brown. So massive thanks, Andrew. Looking forward to checking in a few months' time and seeing how it's all going.
Thanks, guys, and great to see the success and the branching out of what's a really great concept. So
Thank you.
well done.
Thank you.
Thanks, Andrew.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.